Imagine waking up every single morning with the certainty that your money is working harder than you are. Most of us are taught to trade our time for money. We work an hour, we get paid for an hour. It is a linear trap that keeps the vast majority of the world stuck in a cycle of endless labor. But the wealthiest people in society, the ones who seem to have total freedom, operate by a completely different set of rules. They don't just work for money, they acquire assets that print money for them while they sleep. This isn't magic, and it isn't reserved for the elite. It is the fundamental power of the stock market. If you have ever felt like you are swimming upstream financially, it is likely because you are keeping your money in cash, where it slowly dies due to inflation. Today, we are not just going to learn how to buy a stock, we are going to completely rewire how you view wealth, shifting you from a consumer of the economy to an owner of the economy. At its core, the stock market is often misunderstood as a giant casino where men in suits scream at screens and gamble on random numbers. If you view it that way, you will inevitably lose money. You must strip away that noise and understand what a stock actually is. When you buy a share of stock, you are not buying a lottery ticket. You are buying a legal certificate of ownership in a real, breathing business. If you buy a share of a company like Apple or Coca-Cola, you are not just betting the price goes up, you are becoming a partial owner of that company. You are hiring the smartest engineers, the best marketers, and the most ruthless CEOs to wake up every day and work to make you richer. They do the heavy lifting, they solve the problems, and they sell the products. You, as the shareholder, simply provide the capital and reap the rewards of their success. This shift in mindset, from gambler to business owner, is the single most important step in your investing journey. Before you ever open a brokerage account, you have to respect the invisible enemy that is destroying your savings right now: inflation. Every year, the cost of living rises. $1 today will buy less milk, less gas, and less housing 10 years from now. If you bury your money in a backyard or leave it in a standard bank account earning 0.1% interest, you are guaranteed to lose wealth. You are safely becoming poorer. The stock market is the only consistent engine that has historically outpaced inflation significantly over long periods. While the market crashes and corrects, which we will discuss how to handle, the long-term trajectory of the global economy has always been up. By investing, you are essentially betting on human innovation. You are betting that tomorrow, humans will be more productive, technology will be better, and companies will be more efficient than they are today. History tells us that is a very safe bet. Now let's demystify how the market actually works. Imagine a giant auction house. This is the stock exchange. Companies list themselves on this exchange for one reason: to raise money to grow. This is called an IPO, or initial public offering. Once the company is on the market, the price of its stock is no longer determined by the company itself, but by the millions of investors interacting with each other. This is the law of supply and demand in real time. If more people want to buy the stock than sell it, the price goes up. If more people want to sell than buy, the price goes down. It is pure democracy. However, in the short term, this voting mechanism is irrational. It is driven by fear, greed, and headlines. But in the long term, the market is a weighing machine. Eventually, the stock price will move to match the actual profits and performance of the business. As a beginner, your edge is not being smarter than Wall Street. Your edge is patience. You can wait for the weighing machine to work while others panic over the daily voting machine. To understand why you need to start today, not tomorrow, you must grasp the concept of compound interest. Albert Einstein reportedly called it the eighth wonder of the world. Simple interest is earning money on your principal investment. Compound interest is earning money on your money and the money your money has already earned. It is a snowball effect. In the beginning, the results look small. You might invest $1,000 and earn $100 in a year. It feels meaningless. But if you leave that $100 there, next year you earn interest on $1,100. Over 10, 20, or 30 years, this exponential curve goes vertical. The biggest regret of every older investor is not that they picked the wrong stock, but that they didn't start early enough to let compounding do its heavy lifting. Time is more important than timing. A mediocre investor who starts at 20 will often end up richer than a brilliant investor who starts at 40, simply because the math of compounding favors the early starter. However, entering the stock market can be terrifying because of the sheer number of choices. There are thousands of stocks, bonds, mutual funds, and ETFs. To simplify this, you need to understand the three main vehicles you can drive on your journey to wealth. The first is individual stocks. This is picking specific companies, like buying Tesla or Amazon. This offers the highest potential reward, but carries the highest risk. If that one company fails, you lose your money. The second vehicle is a mutual fund. This is where you pool your money with thousands of other investors and a professional manager picks the stocks for you. It's safer, but you often pay high fees for that manager's salary, and statistics show they rarely beat the market average. The third and often the best option for beginners is the ETF, or Exchanged Traded Fund. Think of an ETF like a fruit basket. Instead of trying to pick the single perfect apple, a stock, and risking that it might be rotten, you buy a basket that contains a tiny slice of every fruit in the supermarket. If one apple is rotten, it doesn't matter because you have hundreds of other fruits that are fine. The most famous version of this is an S&P 500 index fund. This is a basket of the 500 largest, most profitable companies in the United States. When you buy one share of this fund, you instantly own a tiny piece of Apple, Microsoft, Google, Amazon, and 496 others. You are not betting on one company, you are betting on the entire American economy. If one company goes bankrupt, it is replaced by a better one. This strategy provides instant diversification, which is just a fancy word for not putting all your eggs in one basket. For 99% of beginners, buying the entire market via an index fund is smarter, cheaper, and more profitable than trying to pick winning stocks yourself. Before we talk about exactly how to click the buttons and buy, we have to address the risk mindset. Beginners often equate risk with volatility. Volatility is just the price bouncing up and down. That is the admission fee you pay for wealth. Real risk is permanent loss of capital, buying something that goes to zero and never comes back. If you own a diversified S&P 500 index fund, the only way it goes to zero is if the entire global economy collapses, all governments fail, and money becomes worthless. In that apocalypse scenario, your cash in the bank wouldn't help you either. Therefore, the stock market, when approached with a diversified mindset, is actually much safer than it feels. The scary headlines you see on the news are designed to get clicks, not to help you build wealth. When the market crashes, and it will, you must learn to view it not as a disaster, but as a sale. If your favorite clothing store had a 20% off sale, you would rush to buy. When the stock market has a 20% off sale, most people rush to sell. You must train your brain to do the opposite. Now let's look at the difference between investing and trading, because confusing the two is how beginners get wiped out. Trading is a job. It involves watching charts, analyzing trends, and trying to predict if a stock will go up in the next hour or day. It is high stress, high tax, and statistically most traders lose money. Investing is a lifestyle. It is passive. It involves buying good assets and holding them for years or decades. As a beginner, you are an investor. Your goal is to be boring. Good investing should be like watching paint dry or watching grass grow. If you want excitement, take $100 to a casino. If you want wealth, put your money in the market and leave it alone. The less you touch your portfolio, the better it usually performs. This is because every time you trade, you likely trigger taxes and fees, and you risk making an emotional decision at the worst possible time. The barrier to entry has never been lower. 20 years ago, you needed thousands of dollars and a phone call to a broker who charged high commissions to buy stocks. Today, we live in the golden age of the retail investor. You can start with $5 or $10.
Discount brokerages and apps have democratized finance, allowing you to buy fractional shares. This means if a single share of a company costs $3,000, you don't need $3,000. You can invest $50 and own 1.6% of that share. This removes the excuse of "I don't have enough money." If you have the money to buy a coffee, you have the money to become an investor. The mechanics are simple. You transfer money from your bank to your brokerage, exactly like moving money to a savings account. The difference is once the money lands in the brokerage, it's just sitting in cash. You must take the second step of actually selecting the stock or ETF and clicking buy. This is a common mistake. People transfer money and forget to invest it. Let's discuss the financial freedom number. This gives you a concrete goal. Investing without a goal is like driving without a destination. You will eventually run out of gas. The general rule of thumb is the 4% rule.